You're watching a stock chart. The price aggressively breaks out to a new high, triggering generic buy signals. So you buy. But instantly, the floor drops out. The price plummets, leaving buyers trapped deep in the red. Relying strictly on whether a stock's closing price is up or down leaves a trader vulnerable to this exact scenario. That is because top-line price movements can be skewed. A stock might gap up or spike based on a handful of trades with very little volume behind them. When you focus exclusively on price action, you're reacting to the surface of the market rather than its underlying momentum. To see the real story, you have to look at the engine driving the market: volume. Volume represents conviction. It shows how much capital is actually being deployed to support a move. This is what the Accumulation Distribution, or AD line, is built to analyze. It is a specialized tool designed to track the flow of institutional smart money. The AD line acts as a filter. If a price spikes but the trading volume is hollow, the line will barely budge, providing a warning that the move lacks real support. By translating raw volume data into a clear trend line, it acts as a market polygraph, helping to distinguish between significant moves and low-conviction noise. Unlike standard indicators that compare today's close to yesterday's close, the AD line focuses on the mechanics of the current trading session. We can map the specific coordinates for any single day: the high, the low, and the final closing price. The math determines exactly where the price settles within that range. If the stock closes near the top, the buyers controlled the session. If it closes near the bottom, the sellers were in charge. Identifying this intraday location is the first step to determining true momentum, regardless of how the broader chart looks. This relationship forms the money flow multiplier. When a strong close near the daily high is backed by high volume, the AD trend line spikes aggressively upward. This scenario confirms accumulation. It shows the bulls are in control and are heavily buying the asset. Contrast that with distribution. The green candlestick ended higher than it opened, but because it closed near the bottom of its daily range on heavy volume, the AD line drops. The falling line reveals sellers dominated the actual volume. The general rule is consistent. A rising AD line points to asset accumulation, while a falling line points to distribution. This multiplier helps identify when a positive daily close is being used to mask a larger institutional sell-off. The most effective way to use this data is by looking for divergence, which occurs when the price and the AD line move in opposite directions. Here we see bearish divergence. The price is climbing to new highs, but the AD line is trending lower and fails to confirm that upward move. This suggests the buying pressure is exhausted and the price corrects downward to align with the volume flow. Bullish divergence is the opposite. The price hits new lows, but the AD line steadily trends upward. This indicates that buyers are quietly accumulating shares at lower prices, which frequently precedes an upward breakout. These signals act as an early warning system, highlighting where institutional players are positioning themselves before it becomes obvious on a standard price chart. It is important to note that the AD line does not account for price gaps. If a stock opens significantly higher or lower than it closed the previous day, the indicator won't capture that initial jump. For the most reliable insights, ignore the minor daily fluctuations and focus on the overall slope of the line over several weeks or months. Most traders pair the AD line with other technical tools, such as moving averages or the RSI, to confirm entries. The Accumulation Distribution line provides a look into the institutional data that drives market cycles, offering a perspective that price-based analysis alone cannot provide.